Bismillahirrahmanirrahim. Students, this is economics and an explanation of chapter 39 from Susan Grant, the current account and of balance of payments. Current account balance of payments. And this chapter, the explanation was asked by many of my students, so for them, I'm going to do it. Starting with the basic definition of the balance of payments, uh, it is actually comprised of many things. For example, in the process of international trade, uh, the country will do the transactions of economic, commercial, and financial nature between the residents of one nation and the rest of the world. Residents of one nation means the residents of Pakistan, whatever they are doing, uh, the economic, commercial, and financial transactions, the process of exchange is taking place with the rest of the world, for example, that will be included in the balance of payments. For example, the exchange of goods for goods, goods for services, services for services, and goods and services for money, uh, which is the most common type right now. And in case of the balance of payments, we have to see that there are three types of accounts which we have to consider: the current account, the financial account, and the capital account. And basically, in case of uh, the O levels course, especially, the current account is part of our course. So, balance of payments, a simple formula is that the balance of current account, whatever you have, surplus or deficit, plus the balance of capital account plus the balance of financial account. So this is a general formula of balance of payments. But as I told you, that we will be focusing on the current account mainly. In the current account, there are four components, and the current account is one of the main accounts of the balance of payments. The first component is the trade balance in goods. So, trade balance means you have to see that, analyze that whether your exports of goods are more or imports of goods are more. That is the first component. So, if your exports of goods which have physical existence, if that is more than the imports of goods, then this component will be in surplus if your exports of goods are more than the imports of goods. That is the first component. And what are the things which we include in the first component? Finished manufactured goods, components, raw materials, energy products, and capital technology. So, machinery and all those things will be part of it. Trade balances or trade balance in services. Again, the comparison is between the exports of services and the imports of services. If the exports of services is more than the imports of services, then you have a surplus in the trade balance in services. If you have more imports of services as compared to the export of services, then definitely you will have a deficit. Deficit means that your expenditures are more as compared to your earnings. The third component is the net primary income from overseas assets. It is the net, so it means that you are assuming that there will be more money coming into the country. If this is not the case, then what will happen? This primary income, net primary income, will also go in deficit if your inflows are less and outflows are more from the country. So this third component include profits and interest and dividends from the investment in other countries, and the remittances sent by the people who from, let's say, from UK to Pakistan. So that will be an inflow for Pakistan. But if some Britisher living in Pakistan and sending out the money to UK, for example, so that is the remittance which is going out of the country. And this is basically, again, the same simple fact is there, that if your outflows are more as compared to your inflows in the net primary income, then it will go in the deficit. If your inflows are more than your outflows in the primary income, then it will be in a surplus. Then the fourth component, it is the net secondary income, and that is basically having certain things, for example gifts and donations. And for example, if there is a flood, we are getting an aid in Pakistan, so that money is coming into the country. So if even in the net secondary income, if your inflows are more as compared to your outflows, then net secondary income will show uh, a surplus. But if your outflows are more, even in the net secondary income, then it means that you are going to get a deficit in this component also. So, overseas aid, debt relief, military grants, and for example, if we are talking about UK is paying certain payments to the European Union, for example. Pakistan, for Pakistan, we can say that if the payments made to the SARC organization, that money is going out of the country. So that is an outflow in the net secondary income. For example, Pakistan is getting certain gifts from Turkey, that is an inflow in the net secondary income. So you have to see that which items are related to which component. And generally, the question is that they give you three components, and the fourth component you have to find out. And they also give you the current account balance. So you have to make sure that it is more of a mathematical question, that you, after adding or subtracting, what value you are getting. A plus sign will always show a surplus, a negative sign will always show a deficit. So you can easily do the question. If you make an equation, all these four components will be there, and their addition should be equals to the current account balance. And you have to balance it out, certain things plus minus, because the final answer should be zero. After adding or subtracting, the answer should be zero. It should be balanced. So that is one of the things which I wanted to explain to some of my students. And this lecture will again be uploaded on the YouTube. Very important, because the students may have confusion regarding this. This was chapter 39, balance of payments and current account.